You guys have any questions?
I just have one comment to make. The reason why we don't think logically is because human brain is supposed to think in heuristic fashion because of evolution. I know it's kind of complex on psychology, but the reason is we don't apply logical outcomes because apparently when we were cavemen, we didn't have the luxury of being retrospective, so we took whatever and we didn't go back and practice it. The survival was the key.
Huh. I mean, yeah, when you
Is that the reason why?
well, you think about it this way. I mean, if our beliefs were a 100% reflection of the way things existed, now think about what I'm going to say right now. If our beliefs, if there was a 100% correspondence between what I believed and the way reality existed, what would that imply? That would imply I'd always have my expectations fulfilled. I'd be in a constant state of satisfaction. You guys with me on this? Because what is an expectation? An expectation is simply my mental representation of what the next moment or the next, a minute from now, 5 minutes or whatever, is going to look like in the environment. If the external environment shows up in a way that's consistent with what I expect, then I'm going to be in a state of satisfaction, right? To whatever degree it doesn't show up in a way that I expect, I will be in some degree of emotional pain. That is a universal characteristic of human nature. Everyone wants their expectations fulfilled. But the point is that if like I said, I'll say again, if our beliefs were a 100% reflection of the way reality existed from its perspective, from the environment's perspective, then we would be in a constant state of satisfaction. We'd always be getting what we wanted. Which implies that if we are not, then something's got to change. Now, in a social environment, if we've learned how to exercise control over people and the environment, we'll make the environment look like the way we want it to. There's always consequences to that. There will be, because nobody likes to have to behave in a way that's inconsistent with what they believe. And if there was harmony between my belief and their belief, I wouldn't have to do anything in the first place, correct? The problem is we can't exercise that kind of control over the market. The only thing we can exercise control over is our own beliefs. And to create them in a way that's consistent with the way the market exists. The market exists in a probabilistic way. It's that simple. If our beliefs that we're operating out of are not consistent with that, then we are not going to create consistent results. It's that simple. We'll create random results. And we'll have a lot of fun. And we'll have winning streaks and we'll have winning trades. The problem is we'll always be susceptible to the catastrophic drawdowns. And they take their toll. Go ahead.
Mark, in your experience, it sounds like we got these perceptual filters. That this exercise eventually takes those things away.
Correct.
We get in harmony with the market.
Correct.
Has it been your experience, or do you think it's to the point that you just get to the point where you just know? I mean, you're so unbiased by anything that what to do next is just obvious?
You mean, in other words, you're operating out of a sense of, like an intuitive sense? Yeah, exactly. You're in the zone. In other words, there's complete harmony between you and your mind, your state of mind, and what the market is offering you in any given moment.
So the market's never trying to hide anything from you, it's just we put the blind.
That's right. Exactly.
So
Go ahead.
is that obvious then?
Is that obvious? What do you mean, is that obvious? It is obvious when you're in that state of mind. That'll be obvious. And when you start thinking about it is when you'll pop yourself right out of it. So go ahead.
Back to your fishing deal.
Yeah.
Doing a lot of fishing. Sometimes I let Rodney catch fish, which I put the rod in the rod hole, and I end up catching more fish that way than I do try to actually fish. Which brings me to the mechanics of this. If we set up precise entry points, which there's no way of doing that with you mechanically get in, or you have stop loss stops to get in. Can you set this up mechanically and let it go on your end? I think I read you on precise entry. I understand that.
It has to be, precise.
But on your precise exit, that is.
You're better off setting it up where everything's precise. What you don't want is to get yourself into a situation where you can't make a distinction between what's going on in you and what's going on in the market. In other words, if you set everything up, if you set this regimen up in a way so that you know that it's you that's having the conflicting thoughts, it's not some, let's say, some judgment that you have to make so that you can rationalize away your mistake.
I've done that with stops on stuff. I'm emotionally attached. If it hits a client, that's okay. I've already done that. So on my treatment ending for the trade, then I can actually pre-plan to what I'm going to take as a profit, pre-plan my loss, put that in there and walk away.
That's right. Yeah, if you want to walk away, the best thing to do, look, if you're already evolved enough where you don't have these kind of problems that I'm talking about, you don't have to do it at all. All I'm saying is if you have the potential to define and interpret market information in any kind of a painful way, then for whatever reason, you probably have to do this exercise. You haven't acquired all the skills that are necessary. Instead of walking away, the best thing to do is actually sit there and watch it, meaning confront whatever it is that needs to be done and do it in that moment, being aware of all the conflicting thoughts. In other words, I'll give you another example. There's a trader I worked with many years ago who owned a couple of construction companies in Texas. He was in his 50s. He was trading bonds. He was losing his ass. He thought, okay, I'm going to go up to Chicago and show these guys something, right? So he bought a seat at the Board of Trade, went into the bond pit, and just got annihilated. So he was having one of his bad days, and someone suggested he come to me for some coaching. And so one of the things that I realized, of course, that he really couldn't even define an edge. And at the time, I was using point and figure analysis, and so I showed him how to define support and resistance within about a 6 or 8 tick point range in the bonds. And so we did this for about 2 weeks, and so it was time for him to go down to the floor and implement what it is that we did. And his instructions were very precise. In other words, if the market was in between, support and resistance, that if it came down to support, he was to execute his trade at a specific price. He was only supposed to risk 3 ticks, which is just about a little less than $100. 3 ticks, and if go 3 ticks against him, he had to get out. If not, and it went in his favor, he waited until it reached resistance. He took his profit and reversed and with the same stop. So the day that he went down there, the market was perfect because it was right in between. It came down to support. As it's coming down, he thinks it's not going to get to his price. He ends up getting in early, like 2 ticks early. It gets to his price where his original entry price in the first place. He thinks it's going to keep on going, and he blows out of the trade for a 2-tick loss. The market reverses, goes back up, does the exact same thing at the top, just completely screwed the whole thing up, right? Now, all he had to do was risk $100 in each case. He couldn't do it. He literally could not do it. He did the same thing the second day, the same thing the third day, so he stopped calling me because he didn't want, this is the kind of guy, he barks out orders to people, he expects them to do it. He thought he could go down to the floor and do the same thing. He found he didn't have any capacity to do it whatsoever. So in the meantime, he's down there trading for 2 or 3 weeks, and he's getting better and better at defining support and resistance. So the interesting part about what ended up happening is that he would end up waiting till the market hit his price and get in, but he was so afraid that the market was going to take his money away, he ended up getting out of the trade for like a 1 or 2 tick profit. Now, what was particularly exasperating for him was that many of these trades, as he went back and looked at his entries, there were many times he had bought the low of the day or sold the high of the day and only ended up with 1 or 2 ticks. So this was like really bothering him. So I didn't hear from him for about 3 weeks. He called me up, explained to me what was happening, and his solution to the problem. His solution to the problem was to go ahead and up his size up to about 20 or 25 contracts. So, hey, makes sense, right? The problem with upping his size, so see, instead of learning how to hold on to his trades, okay, he's going to up his size and get the money, right? Well, the problem with upping your size is that you go from a 1-lot trader in the bond pit to a 20-lot trader. You're dealing with a completely different set of guys. There's all kinds of problems with that. Anyway, I knew he was gonna really, it was a disaster. And I knew it. I didn't say anything to him. I thought, hey, just let him, he's going to do it anyway. What difference does it make? So he did. He called me up. He lost all the money he'd made in the last 3 weeks, plus a bunch more. He said, okay, here's the key. I am ready to do anything. Okay? He was ready to do anything. And he was. He sincerely was. So I gave him an exercise, a real simple exercise. Very similar to what I just gave you guys. And this exercise worked great for him. He had to do the exact same thing as before. The only difference is that when he got that trade on, he had to put his hands in his pocket, turn and look at the clock on the wall and be in agony for as long as he could. He had to put his hands in his pocket and look at the clock, and here were the parameters. The market either stopped him out, or he had to stay in it for 20 minutes, whatever came first, or it reached his objective. 20 minutes, And the longer, and the first couple of times he, I don't remember, but it's probably only a minute or two that he could stay in the trade. But he worked his way. He was very diligent about it. He worked his way up to the point where he could turn around and look at the clock and face each agonizing second until it was an exit that we're talking about. You are down. You are headed. You're either on the path or headed down the path of ultimate exasperation. It isn't going to work.
If this is about human reaction, then what is better? Is it better to just buy a system that exists, which many have tremendous track records in, and leave it with the broker and let him trade that amount of money? Or is it better to trade that same amount of $1 if the human factor is...
I can't answer what you think is better, because it has to be within the context of what you're trying to accomplish. You have to say, what are you trying to accomplish? If what you're trying to accomplish is just to acquire profits and you don't want to trade, then give it to somebody else to do. The question really answers itself. Just put it within the context of what you're trying to accomplish. Put everything within the context of what you're trying to accomplish. What's your objective? Then do it whatever way is satisfying to you. Do it in a way that's most satisfying to you, whatever that is. And only you can determine that. The man says I got 3 minutes. Anybody else? If not, we can end 3 minutes early. I can take a break. Are we all done? Okay.
Okay, I'd like to introduce Mark Douglas. Mark is best known for his books, probably The Disciplined Trader and my favorite, Trading in the Zone, which I had the privilege of writing the foreword for. I have to tell you, Mark's book, Trading in the Zone, really had a big impact on me because it deals with the mental aspect of trading. You can also find out more about Mark's products at markdouglas.com. So here he is, Mark Douglas.
A lot of familiar faces. I'm just getting in front of the room. I'm kind of amazed, actually, how many people I recognize. It's pretty nice. What's that? What? You have to get the microphone volume turned up? Oh, you can't? You couldn't hear me just then? Really? Oh, I'm sorry. Oh. Oh, well, first of all, I don't think this microphone is on for you. This microphone is on for that back there. So I don't actually have a microphone. This is not amplifying my voice. So if I'm not talking loud enough, just let me know. Normally I talk loud enough. I don't know why I maybe started out. So anyway, it's nice to be here. It really is. It's nice to be. I flew in from Scottsdale, Arizona, and who read the paper today? Who read the Orlando paper? Nobody read the paper this morning? You did? Only one person? Yeah, there's an article actually in the Orlando paper about middle way through the front section talking about how hot it is in Arizona right now, or at least in Phoenix. People don't seem to believe just how hot it gets there, but I'm telling you, it really gets hot. It's like, how many people had the heat on last night in their room? I'm not kidding. I'm really not. Last week we had temperatures up to, if the news stations report the temperatures of being 116, that means there were 118 to 120. And we set a record last Monday for the highest low temperature in Arizona recorded history. It didn't get below 96 degrees. That was our low of the day, 96 degrees. Now, not to take anything away from Arizona weather, because 8 months out of the year, it couldn't be more heavenly in Arizona. I mean, the weather is absolutely spectacular, but we do pay for it. We pay for it this time of the year. And so, you know, if you're interested in coming out to Arizona, I would definitely suggest it, you know, late October through maybe April, but otherwise, this time of the year, be prepared for some really unbelievable temperatures. But this is what we need right here. We need this rain because we're in a really severe drought. But anyway, enough about Arizona. You guys want to know about trading, right? Trading psychology, more specifically. What I'm gonna talk about is the psychology behind creating consistency in your trading. And an interesting thing that I found even about 3 weeks ago, I did a presentation in Toronto, and there were probably about 100 people in the room, and I was really kind of amazed at how many people really didn't have a definition of what consistency was. Just think about it for a second. That they really didn't know, what does it mean to really create consistency? Like, when I asked the question to the audience, nobody really could answer the question. What is consistency? I mean, if you're going to create it, if it's something that you're going to manifest in your life, I mean, or in your trading, it certainly has to be something that you know what it means. You have to know the parameters of it. And I'm just going to simply define consistency as, as a nice, steadily rising equity curve. That's all. Just a nice, steadily rising equity curve, okay? At a nice, let's say, 45-degree angle. Will that equity curve have any drawdowns? Yeah. But what kind of drawdowns? Small drawdowns. Small drawdowns that reflect any trading system or methodology or any particular way in which you decide to trade, the kind of losses that you will experience as a result of being a trader. It's a natural part of the business that we will have small drawdowns. But what isn't consistency are the kind of, let's say, a kind of equity curve that looks like this, with a huge drawdown, and build it right back up again, another huge drawdown, build it back up, and another huge drawdown. Now, most traders who don't understand the nature of trading or the nature of the psychology behind what it means to be consistent, they will attribute these huge drawdowns to something that happened in the market. They'll always try to find a reason to determine what is it about what the market did on this particular day or in this particular trade or whatever series of trades created this huge drawdown that caused that to happen. And then go on a search to find what it is. What I'm going to establish, hopefully today in the next 2 hours, is that those huge drawdowns are not the result of something you did not know about the market. They are not the result of something you did not know about the market. They are the result of something you didn't know about yourself. And there are ways to prevent that. And those ways to prevent it are what it means to really create a nice, steadily rising equity curve. And those ways basically fall into 4 general categories. None of this is, by the way, none of this material is in that book. So there's no point in looking. I just didn't want you to waste your time. There's no material in the book. You've got the videotape. I mean, come on. So you just need to sit back and listen. Anyway, so we've got 4 basic categories. One is that you have to have an edge. In other words, you have to know enough about the nature of the market and how it moves so that you can determine when there's a higher probability of one thing happening over another. That's how I'm defining an edge. When there's a higher probability of one thing happening over another. And then the next category is that you have to learn how to think in the market's perspective. I just simply, as a heading, would say that you have to learn how to think in probabilities. Now, this is really can be a, this is really kind of where most traders have their, let's say, have the greatest amount of difficulty. And first, in recognizing what it is, what it means to think in probabilities, and then once they recognize it, implementing some process or series of steps where they're actually retraining their mind to think in probabilities. Now, this is what I'm going to spend most of the time on in the next 2 hours. And just before I even get into it, just so you kind of have a little bit of a background, is that our minds do not naturally think that way. Our minds don't naturally process information in a way that will cause us to, let's say, be in harmony with or have, let's say, be in correspondence with the nature of the way the market exists. And so we have to do something very specific to train our minds to think in probabilities if we want to create consistency. The third category is all the, let's say, conflicting energy that exists inside of us. I'm saying conflicting energy, conflicting beliefs, or whatever that would argue against us accumulating vast sums of money as a trader. Now, what kind of things am I talking about? Anybody have any ideas of what I might be talking about?
Just a general belief system.
A general belief system. What's that? Go ahead.
Say a general belief system maybe from childhood.
A general belief system about childhood, but can you think of anything specific?
Self-doubt.
Self-doubt? Well, okay, but anything more specific than that even?
Filthy rich.
Filthy rich. Now look at the word filthy and rich, okay? Where does that word filthy come from? It can come from a number of different sources, but what people have to understand is that we grow up. We can grow up. We don't say we do grow up. We can grow up with any number of things that we've learned throughout our lives that are going to fall into the category of what I'm going to just say are self-sabotaging beliefs. In many cases, they're religious-based beliefs. Because essentially, as traders, what are we doing? We're basically taking money from other people with no services rendered. That's basically what we're doing as traders. And there are a lot of religious beliefs that let's say that would really rail against the idea of doing something like taking money away from other people with no services rendered. And so as a result of, we build up our skills, we build up our knowledge about the nature of trading, we get better and better at it, and all of a sudden find ourselves, or maybe not in the moment find ourselves, but when we look back and with a little bit of introspection and say, why did this happen? We make trading errors that cause these kinds of drawdowns. Sometimes it can be simple ones, like even a buy for a sell. I did it just the other day. It didn't create a huge loss because I caught it, but the point is that if I wasn't conscious of what I was doing and why I was doing it in the moment, I could have very easily let that trade go, and it could have been more than what I anticipated. And the problem is that when we experience these kind of drawdowns, they create psychological damage. They create the kind of psychological damage that's very difficult to recover from, or it can be difficult depending on one's skill level and being able to do so. And what kind of psychological damage am I talking about? The lack of self-trust. We don't trust ourselves anymore. And when we don't trust ourselves to do what we need to do when we need to do it without any reservation, without any hesitation, what ends up happening is that we end up generating fear. And what we're going to find out in a little bit is that fear has a very insidious effect on our ability to be objective and see what the market is offering us in any given moment. Because we can define the market as this kind of never-ending opportunity flow. And the market is basically giving us an opportunity in any given moment to get in, add to, detract from, or get out. But it's this never-ending flow. Now, if we're not perceiving it as this never-ending flow, the market's not causing us to perceive it that way. It's what's going on inside of us that's causing us to perceive it as something other than this never-ending opportunity flow. And those are the kinds of internal forces that cause these kind of drawdowns. That's the third area. The fourth area is learning, let's say, building a specific kind of mental framework that will allow you to recognize when you've crossed through the threshold of euphoria, so let's say from normal confidence to overconfidence, or from normal confidence to a state of euphoria. In other words, there is what I'm going to call a psychological threshold. Below this threshold, you're just confident. Once you pass through it, you're in a state of euphoria. And why would being in a state of euphoria be a problem? What's that? Loss of objectivity. Anything else? Feeling invincible. Why is feeling invincible a problem with when you're interacting with the market? Everybody understands the implications? In other words, when you've crossed the threshold into a state of mind of euphoria, it is impossible to perceive risk. That is the nature of euphoria. In other words, the nature of euphoria is that from our individual perspective, from the perspective of our state of mind, in that state of mind, it would be impossible for me to perceive that anything can happen other than what I expect to happen. Anything. The only thing that's going to happen is what I expect to happen. And as a result of being so absolutely sure that what I expect to happen is going to happen, what would be the next step in this process? To break my money management rules, right? In other words, to put on a position that would be much larger than what I would normally trade. Maybe 10 times, maybe 20. Well, there's no risk. Why not? Right? Why not? Now, the problem, of course, with putting on an inordinately large position is that it doesn't take very much movement for the market to put you to put you in a huge losing trade. And the problem there is that if I've got this huge position on with being absolutely positive that it's going to work, and then the market just goes against me by just a little bit, I can go from this state of euphoria, from this state of, let's say, in essence, heaven on earth, to a state of extreme agony and pain of hell on earth virtually instantaneously. Can I not? And then once I get into this state of mind right here, I will be in mind freeze. My mind will freeze up. I'll be, let's say, paralyzed to do anything, and I just sit and watch as the market takes my money away until something snaps inside of my mind, so okay, that's enough, and I get out. And then I look back at my equity, and I see one of these huge drawdowns, okay, and I think, oh my God, how did that happen? Now, if you don't understand the underlying dynamics of what I've just talked about, you're gonna go look at the market, and you're gonna try to find what happened in the market that caused that. What set of variables, what set of market variables caused that to happen? You see, the market didn't have anything to do with it. Nothing. To create consistency, in essence, what we have to do is learn how to trade without making errors. Does that make sense to everybody? Right? But then what is a trading error? Okay, if that's the case, everyone say, did everyone nod their head? Yes, yes, okay. We're not, okay, it makes sense, right? To create consistency, I have to reach higher and higher levels of error-free trading, right? There's a correlation there. In other words, everyone sees the correlation, right? But then if I said, okay, what are trading errors? List them. What? Not following your rules is a trading error. Okay, good. But these are things you should be able to, well, right off the top of your head, right? You guys are all in the business of trading. Every single one of you would probably say, yes, my goal is to create consistent results. If I said, what do you want? What's your objective? What are you trying to accomplish here? Well, I want consistency. And yet, if we just establish that consistency is a function of the lack of errors, you should be able to rattle off those errors right off the top of your head so that you can recognize them when you're making them. Right? What's the biggest error that virtually all traders make, except for the ones who have gotten to the point where they don't make them anymore? What's the biggest number one error that traders make? What? No. I know I'm right. Okay. Yeah. And so but see, I know I'm right. But how does I know I'm right manifest itself into a trading error? What?
Not exiting so that you can take what you see as the next correct signal. You can't take it because you're locked in the wrong position that you did not exit.
I'll agree with everything you said. I'm just going to say it a little bit differently. What's that? Yeah, not predefining your risk. Everything we just said, I'm just going to say it a little bit differently, not predefining your risk. Now, I'm not going to ask people to raise their hands, but I bet there are people in this room who still will get into a trade without predefining their risk. Now, why won't people predefine their risk? Why is that so hard to do? Why do you think that's so hard to do? What do you think of the underlying dynamics are? Well, yeah, you don't want to be wrong. Now, see, when you've learned to think in probabilities, what you're going to learn, what you're going to understand, is that trading is not a right or wrong endeavor. It has nothing to do with being right or wrong. But this is really important. Yes, we don't want to be wrong, and we don't want to lose money. And there's a problem here in terms of the way our minds are designed to think. If I think of trading, getting into a trade, as being something I can be right or wrong about, and I have not accepted the risk, meaning I have not accepted the dollar value of the potential loss that I can incur from that trade by not predefining it, or by predefining it and still not accepting it, then my mind has the potential to associate whatever's happening in the market now with something that's happened in my past. Meaning our minds are wired to associate. Meaning that if I haven't changed the way that I think about trading, I have the potential to look at any given trade as, well, let's say any given trade has the potential to tap me into the accumulated emotional pain of what it means to be wrong, or every time I've been wrong in my life. Yeah, exactly. I'm going to say that again. If I haven't redefined trading to think about it in the appropriate way, based on the way that I'm going to explain in a moment, being wrong on a trade has the potential to tap me into the accumulated pain of every time I've been wrong in my life, because that's the way our minds are designed to think. They're designed to associate. So if that's the case, little wonder that I'm going to avoid predefining my risk. Because here's what's going to happen. For me to predefine my risk, see, I don't want that to happen. I don't want to be in that state of pain. For me to predefine my risk, what do I have to do? I have to gather evidence that will suggest why this trade might not work, right? I have to gather evidence to say, okay, what are the things that could happen that would tell me, or what does the market have to look like, sound like, or feel like to tell me this trade isn't working? And I have to gather evidence to tell me that so that I know how to recognize it. But the problem is if I gather too much evidence, I might talk myself out of the trade, right? Yeah. And if I talk myself out of the trade and it turns out to be a winner, then I could be in a state of agony that might be even greater than had I put the trade on and it turned out to be a loser. So how do I compensate? So I've got a mental dilemma here. I've got a dilemma. How do I resolve the dilemma? Gather enough evidence, in other words, have the trade be so technically or fundamentally sound, whatever method you might use, to the point where I have convinced myself that I'm right. And see, if I'm right, there's no risk, right? Why predefine the risk if I'm right? There is no risk. I wouldn't be doing this if I didn't think I was right. What's that?
Not doing has an implicit risk.
There's people say, go ahead, say that again.
Not doing still has an implicit risk that we don't associate it with.
Yeah.
Not doing something has an implicit risk in not doing something.
Right.
That is also a risk.
Right.
Normally associated as a risk. Inaction. Inaction is a risk. Fear.
Go ahead.
I think part of your belief system takes in hope is something we are trained to have. We always look forward, hoping things will be better. So when I'm wrong, that fellow jumps up there and says, "Don't worry about it."
I know exactly. I'm going to give you an example that really that typifies exactly what you're saying. And see, here's the thing. Here's the problem with trading. I'm just going to put up some typical errors that we make over and over again all the time. Let's see if we can we, how do we need to adjust it? Go forward or back? Oh, I'll just move it up. Anyway, here's what's interesting about these errors. Okay, one, hesitate, get in too late, jump the gun, get in too soon. Don't define your risk in advance of putting out a trade. Define your risk. Don't take your loss and it turns out to be a bigger loss. Get out of a winning trade too soon. Leave money on the table. Get out of a winning trade. Let a winning trade turn into lose without having taken any profits. Move a stop closer to your entry point. Get stopped out, and the market trades back in your favor. Now, here's what's really interesting about trading, and the biggest one, like I said, the biggest one is that not predefining your risk, and that I just went through the whole dilemma of the psychological dynamics behind that. Everybody understand that dilemma? Go ahead.
Could you just restate, you said being wrong has the potential of?
Tapping you into the accumulated pain of every time you've been wrong in your life. And that's definitely something we're going to avoid. Our minds will automatically alter the way we perceive the market to help us avoid that from that happening, okay? Now, I'll explain the underlying dynamics of that in a second. But there's a real important point that I want to make here, is that these are all trading errors. Will everybody at least acknowledge they're all trading errors? I mean, are we all together on this? Okay? However, here's what's really interesting about trading and why it can be so difficult to create consistent success is because you can make every single one of those errors over and over again and still find yourself in a winning trade. You don't have to know. Yeah, right. The microphone didn't pick up, but someone back there said, "Thank God." Now think about the nature of trading. What skills do you need to find yourself in a winning trade?
Consistency.
What? No. What skills do you need to find yourself in a winning trade? None. Zero. Think about that. You don't need to know anything to find yourself in a winning trade. Right? Nothing. You don't have to have any skills whatsoever. And if you can find yourself in a winning trade without having any skills whatsoever, once, can it happen again? And can it happen again? Yeah, it can. We don't know what the limit is to how many times it can happen without having any knowledge whatsoever. What do you need to know to find yourself with a winning blackjack hand? Nothing. What do you need to know about roulette? Nothing. What do you need to know about craps? Nothing. What does that suggest to you? Do you see any correlations here? Do you see any correlations? What does that suggest to you about the nature of trading? It's gambling. Absolutely. Now, interestingly enough, when I proposed this in Toronto 3 weeks ago, they really railed against it. Oh, you would not believe how difficult it was for them to wrap their mind around the idea that trading was gambling.
Not very religious statement.
What's that?
Not a very religious statement.
Yeah. Yeah. And interestingly enough, to really be consistent, to create consistent results, you have to acquire a mindset that is really consistent with the kind of mindset that a good, not a compulsive gambler, but a professional gambler would have, or the kind of mindset that the casinos have.
Does that mean that all the kids living in Las Vegas?
I don't know. I mean, because look at it. What do the casinos do? They spend billions of dollars building these grandiose hotels They have to, now think about this, they have to justify spending that kind of money. They spend billions of dollars, you know, building these grand hotels to attract people into playing an event, wagering on an event that all of us know has a random outcome. And yet they create consistent results for themselves. There's a reason why. It's because they think about it in the appropriate way. As traders, if you can learn to think about this in the appropriate way, you can become the casino. Because your technical analysis will put the edge in your favor. You will get an edge. But if you can't use that edge appropriately, meaning that if you consistently make these errors or any other type of errors, you will not create consistent results. You will create random results. And the problem with creating random results, even though it can be a lot of fun, because you can end up on huge winning streaks. Because keep in mind, you can make every single one of those errors and still end up in a winning trade. You can be the best analyst in the world or the worst analyst in the world. You can have the best reasons or the worst reasons. It doesn't make any difference. You can still end up in a winning trade. But as long as you're susceptible, as long as you're susceptible to this, okay? As long as you're susceptible to these huge drawdowns, you are creating accumulated psychological damage that will have an enormous impact on your ability to make consistent money. Eventually what will happen is if you don't understand the underlying dynamics of these drawdowns from trading randomly, you'll end up with typically analysis paralysis. You'll become an incredible market analyst and the inability to take advantage of what you perceive as an opportunity. You won't be able to put your trades on. And you'll see the gap between what you know, what you understand, what you've learned about in terms of opportunities, and your bottom line results grow ever wider, wider and wider and wider. So are we kind of ready to get to the way we need to think to, you know, if I kind of set this up all right for you guys? So where do we want to go? What do you guys want to know now? What?
I used to go to Vegas for 13 years with the shopping center convention.
You say the shopping center convention? Okay.
I never put one nickel I never gambled the entire time I was there. I've been trading full time for 6 years, putting much more than a nickel in. Is there something really sick about me? Or
Sick? No,
maybe I get this answer later.
well, no, I'm going to say no. I don't see the correlation between why you think because you went to Vegas and didn't gamble. I mean, why you think. I mean, I can think of things.
Gambling, this is not to me.
Yeah, well, the sooner you think about this, what I'm saying to you now is that the sooner you think about this as gambling, the easier it'll be to create consistent results.
I already have.
Well, great. Yeah, so why would you say that why do you think that there was some sort of sick implication then?
Well, because I was afraid of the risk of gambling in Las Vegas, but I'm not afraid of the risk of trading.
Okay. If you've accepted the risk, that's one of the key issues right there. One of the reasons why people have such a difficult time and make these errors is because they have not accepted the risk. If you've truly, and what does it mean to accept something? Because he's bringing up a really good point. What does it mean to accept something? What is the definition of true acceptance?
You don't have to control it anymore, you can let it go.
Well, I understand where the not controlled comment comes from, and let it go. I'm not going to argue with either one of those statements, other than to say that the way I define acceptance is that when you've really accepted something, you've reconciled it, meaning to the point, reconciled it where there's no other potential, there's no potential for anything else inside of you, meaning inside your mental environment, any belief that you've ever acquired to argue against what it is that you've accepted. There is no conflicting energy. Not something you have to rationalize away or justify or anything else. True acceptance means there's no conflicting energy. And essentially, as traders, of course, what we have to do is get to the point where we've accepted the risk of trading with no conflicting energy. Because if there's anything else inside of us that argues against what it is that we're doing, for whatever reason, it will create some degree of fear, and to whatever degree of fear that we're operating out of will narrow our focus of attention and take us out of a state of objectivity, or let's say take us out of this constant opportunity flow that the market's offering us. We'll be further and further away from that flow. So what we have to do is learn to train, or what we have to do is step into a process of training our minds to think in probabilities. Now, what exactly does that mean? How do we know that the market exists from a probabilistic perspective? How do we know that it's even gambling in the first place, based on however it is that we're going to define gambling? Isn't gambling, let's say, an event, a game that has a random outcome? Does trading have a random outcome? There's no difference, is there? And how do we know that trading has a random outcome? How do we know that whatever particular way that you might define your edge, meaning whatever methodology you use to determine this is a time to buy and this is a time to sell, or vice versa, or this is a time to get in, this is a time to get out, this is a time to take profits, this is a time to add to or detract from your position. Whatever that is, how do we know? How do we know for an absolute fact that there's a random outcome?
It's not a guaranteed result.
Yeah, but how do you know that?
Because the market moves after you get out.
Understandably, yes, the market moves, and what's creating that movement?
No, you, the randomness.
No, well, no, but what? No, really, what's creating the movement?
Buyers and sellers.
Other buyers and sellers, right? So if you decide to buy at this point right here, what is now required for you to find yourself in a winning trade? No, what's that? Yeah, there has to be more buyers, right? Someone has to be willing to bid the price up further. What's that? Yeah, someone has to be willing to bid the price up further. If you buy, someone has to buy after you. If you sell, someone has to sell after you. If those people aren't there, then you're not gonna find yourself in a winning trade. It's that simple. If those people aren't there, you were the last buyer, right? At least in that time frame. In that time frame, you were the last buyer. What else can happen to determine, regardless of what our edge is, that we might not find ourselves in a winning trade?
News.
What? No, not new. No, just really fundamental. Just really fundamental. I'm just getting what it takes for you to find yourself in a winning trade. Someone has to buy or sell after you. What else can happen? The opposite.
Somebody could get in and you comes in and buys a lot more than
You could be a buyer and some huge seller comes into the market, right? So in essence, I'm going to make the statement that it only takes one trader somewhere in the world to negate the positive outcome of your edge. Theoretically, usually it's more, but theoretically, it only takes one trader somewhere in the world to negate the positive outcome of your edge. Does anybody want to argue with that statement? Now, interestingly enough, no one wants to argue with it. Chances are, and we didn't get a rate, I didn't ask for a show of hands, that there are people in this room who have put on, and maybe still, or let's say before this morning, put on trades without predefining the risk. Now I'm going to ask you if you really, truly believed that it only takes one trader somewhere in the world to negate the positive outcome of your edge. If you really believe that, would it be possible for you to put on a trade without predefining your risk? Anybody else? I got one no. Anybody else? Yeah. You guys agree or not? See, if you really, now, and this is really what we're talking about here. We're talking about a set of beliefs that create a state of mind. A state of mind that compels you to be consistent, that compels you to do exactly what you need to do when you need to do it, without hesitation, without reservation. If you really believed that it only took one person somewhere in the world to negate the positive outcome of your edge, you would not be capable of putting on a trade without predefining your risk. Because the moment that you started to do it, it would create a conflict. And somehow or another, you'd have to argue away the conflict. You'd have to argue away in your mind and justify why you're going to put on this trade, knowing that all it takes is someone somewhere in the world with a different belief about what's high and what's low to make that trade a loser. Are you guys with me on this? How many people in this room have ever played slots? When you put your quarters or dollars in slot machines and you push the button or pull the handle and the numbers didn't come up, tumblers didn't come up in a way that gave you a payout, did you think you were wrong? Why?
So I accepted the risk.
You accepted the risk, and what else? What other reason? Why?
Next time.
Next time? Okay, and what other
I
reason?
got 2 sevens instead of 3 sevens. Because I have no control.
Because you have no control. Okay, what other reason? These are good. All good reasons. What? What's that? That's accepting the risk, but there's another reason.
You didn't expect to win?
No, not necessarily. You expected the winner, you wouldn't put the money in. What else? Yeah, you believe in random outcomes. Your belief in random outcomes prevented you from making the connection about being wrong. You believed that the outcome was random. And therefore, there's no connection. How is it that you think that thousands of people, millions of people on a daily basis can go into a casino and shove money in these machines and not come away, totally emotionally traumatized? If these were traders, they wouldn't be able to do it. If there were traders sitting there with the kind of mentality the traders have sitting in front of these machines, it would be impossible. You guys would be walking away completely traumatized. The reality of trading is that it is a probability game. Because if you just break it down to the most fundamental level, what do you have? If you just take the market and break it down to this most fundamental level, what do you have? Buyers and sellers that do what? Create what? Up and down ticks, right? At the most fundamental level, what we have are buyers and sellers who create up and down ticks. And how do they create their up and down ticks? What has to happen for a tick to go higher than the last or lower than the last? What's that? Volume, but what's that? Somebody has to have a stronger belief in the future. Why do we know that for a fact? They want to pay more. In other words, if you look at trading at the most fundamental level, and this is really critical that you understand this, if 9 was the last price, there's only two ways you can make money in trading. You've got to buy low and sell high, or sell high and buy low. Now, if 9 is the last posted price, what's low? 8 is low and 10 is high, right? Now, what does it tell you if someone is willing to actually buy it at 10 instead of buying it at 9 or 8? Yeah, they believe it's going to go to 11, or otherwise they would have waited, right? But what about the guy selling it to him? He also has a belief too. He wouldn't be selling it to him if he didn't think that the next tick was going to be 9 or below. So what you've got is you've got two conflicting and competing forces in every single trade. Both traders are doing it to make money. Both traders believe they are right, or they wouldn't be doing it. But what's the difference? One has to have a stronger conviction in their belief, because they are willing to do the opposite of what they have to do to make money at least in that moment. The opposite is they are buying high instead of buying low. They are creating movement. They are actually stepping up and creating movement where the guy on the other side of the trade is passive, doing exactly what he thinks he needs to do. He's selling high relative to the last price. So all market movement is simply a function of what, no matter what the reasons are. See, it doesn't really matter what everyone's reasons are for doing all this. It doesn't matter. Because as we already know, most people think they've got good rational reasons. The reality is they're trading randomly anyway, aren't they? So what it all boils down to is all market movement is a function of what traders believe about the future and how convicted they are, their degree of conviction in their beliefs. Now, all this interaction, all this belief and conviction and the degree of conviction results in simply up and down ticks. Just up and down ticks, okay? Now, what technical analysis has done for us is basically help us recognize that there are patterns in the group dynamics. In other words, you've got a finite number of people who are interacting together day after day, week after week, and they will create behavior patterns. The dynamics here aren't any different than individuals who will respond in exactly the same way under the same conditions or circumstances over and over and over again. Groups do the same thing. They create behavior patterns. So the ticks, so we got individual ticks that form into these larger patterns, and these patterns we have found repeat themselves over and over and over again. Right? And as a result of the way our minds are designed to think, it is natural for us to think that if I can find consistency here, meaning this pattern repeats itself over and over again, that the outcome should also be consistent too, right? Wrong. The outcome will be consistent, wrong to an extent. Well, the outcome will be consistent over a, what? Large sample size of trades. So you've got individual patterns where the patterns themselves can look exactly like the previous one, can measure mathematically exactly like the previous one, but will the outcome be the same as the previous one? And why? And we got people shaking their heads, which is good. Not everyone's shaking their head, agreeing. But the point is, how do we know for a fact that the outcome may not be the same? Because even though, like I said, visually they can look exactly the same and measure exactly the same, there are still always going to be different people involved in this trade. And it only takes one person somewhere in the world to have a different idea to negate the positive outcome of that trade, for example, if you bought that support line. That's just one trader. That's all it takes. So what it means is like it isn't any different than the concept of if I flipped a coin, an evenly weighted coin, 1,000 times, I had 1,000 flip sample set. I will find that each sample set has a relatively even distribution between the number of times heads come up and the number of times tails come up. You with me on this? It'll be close to 50-50. That is a pattern. That's a pattern I can rely on. But within that 1,000 flip sample size, do I know the distribution between the individual heads and tails? In other words, I don't know what the distribution is. I can get 10 heads in a row, I can get 10 tails in a row, I can get 5 heads, 3 tails, heads, tails, heads, tails, heads, tails. All in all, it's going to come up to 50-50. Casinos. They've got basically a 4% or 4.5% edge in blackjack based on the way they've got the rules set up. That means that of all the hands played, or let's say if there's $1 million wagered on any particular table, they're going to end up with $45,000. That means that takes into consideration all the big winners, all the big losers, everybody in between. Do they fret? They sit there and fret over every single hand that's played? No, they don't. They've learned to think about it appropriately. Go ahead.
Mark, real early in my trading career, I went to a seminar, and the person speaking said to the group, if we flip a coin 20 times, how many of you think there's any chance that we would have, say heads is a winner and tails is a loser, that we would have 12 or more heads or tails in a row? And nobody in the group believed that it was possible. We then proceeded to flip the coins again. Out of the 20, 14 came up heads in a row.
Oh, yeah, I believe it. Yeah, to me,
And
that's.
everybody
Yeah.
was just astounded
Right.
because nobody ever thought, it's like, you think, can I ever possibly have that many losers in a row? Well, there's proof positive.
Oh, yeah.
Just when you think it won't.
Absolutely. But if you did it flip 1,000 times, you still come up close to 50-50. So now, just based on what I've just said just now, what would that require? What would that require of us to create consistent results as traders?
Trying to find a 50 way to win.
Well, no, you got to have an edge. You've got to have an edge. In other words, yeah, to execute your trades without thinking about the outcome of each individual trade. In other words, every single error, guys, look, and girls here, every single error that's on that list, you cannot make. You cannot make any one of those errors without believing you think you know what's going to happen next. Just take a moment and contemplate what I just said. You can't make any one of those errors without somehow thinking or believing that you know what's going to happen next. And that's why you can't create consistent results if you're not creating consistent results. It's because you're still susceptible to making those errors. And the way you're susceptible to making those errors is because you're susceptible to defining all these R's, these up and down ticks, defining the up and down ticks in some way as potentially painful. In other words, you are taking basically a neutral event that you're observing. And what do I mean by neutral event? What? No, neutral event emotionally. Neutral in the sense that can the environment, let's say, or let me ask you, is the information that the market generates about itself and its potential to move inherently joyful or painful information? Is it positively or negatively charged information? What's that? Well, no, I'm asking from the market's perspective. Is the information that the market generates about itself, is it positively or negatively charged? It's neutral, right? Okay, it's neutral. Is there such a thing as positively charged information? No? No. Just in the environment. Is there such a thing as positively charged information? Yes, okay. Is there such a thing as negatively charged information? Okay. In other words, people expressing affection and love can be positively charged, right? Or is positively charged. People hurling insults at you is negatively charged, right? Okay, so the market does not generate, as a characteristic of its existence, positive or negatively charged information. If that is the case, then how is it that we can feel fear?
Because we're attacked, we reject.
Yeah, in other words, somehow or another we've interpreted the information in a way that causes us to feel that way, right? So from the market's perspective, it's neutral. It's the interpretation process that causes us to define it in a way or interpret it in a way where it's potentially painful. And as soon as it becomes potentially painful is when we know what we think is going to happen next. In other words, why am I hesitating? Why am I hesitating? Why am I getting in too late? Why do I do that?
Because I think it's going to be different next.
Yeah, because I think I know, because I don't think it's going to work, right? Why am I hesitating? I don't think it's going to work, and I got to wait. Because I don't remember. I know what's going to happen next, or at least I think that I do. Why am I jumping the gun? I know I'm going to miss out, right? I'm going to miss out. I got to get in now. Why don't I predefine my risk? Yeah, I know I'm right.
I back-tested it.
What?
I back-tested it for 10 years.
I was worried about the how much time have I got here? 5 minutes?
9.
About 9? Oh, okay, I'm sorry. Go ahead, I'm sorry.
Take 10.
Take 10.
I back-tested it for 10 years.
Uh-huh.
So I did my walk-forward testing, my analysis is correct, my technical fundamentals. I only wrong. You cannot be wrong.
You cannot what?
I cannot be wrong.
You cannot be wrong. Yeah, right. Exactly. See, every single error that we make is always going to be the result of thinking, feeling, or believing I know what's going to happen next. But the problem, as I said before, is that this is only an error. It's only an error within the context of what you're trying to accomplish. Now think about what I just said. These are only errors within the context of what you're trying to accomplish. If you're trying to accomplish consistency, then these are trading errors. If your objective is not consistency, even though you might say that it is, if the reality of your trading is that it's not consistency, then every single thing that you can do here could result in a winning trade, and it's not an error, obviously, then, is it? If I can hesitate and it ends up in a winning trade, then I did the right thing. If I can jump the gun and I end up in a winning trade, I did the right thing. It's only the accumulation of these errors that cause these massive drawdowns that end up hurting us. Okay, so what we have is the market works the same way in terms of let's say trading works the same way in that we've got patterns, the patterns repeat themselves, but the outcome to each individual pattern is random. And we know that because there are always different participants making up any particular pattern that might look, sound, or feel or measure exactly the same as the last time that it occurred in the market. Which means that there's always a risk. It's just like a number of people have read Trading in the Zone. Remember the example I used in Trading in the Zone about working with a trader who came to me for consultations, and he was like a really terrific analyst, but he never made money as a trader, and he blew through a bunch of his family's money and his friends and anybody he could talk into opening up an account for him. And so after going through a lot of people's money and a lot of people being pissed off at him, he came to me for help, and I said, hey, look, you've got a number of different issues here that you're going to have to work through that might take, an extended period of time. Why don't you get a job doing something and earn your money legitimately? And so he got a job as an analyst for a clearing firm in Chicago. And he, like I said, he was a good analyst, and they paid him really well for it. And so the president of the firm, who was a retired grain trader, never traded, using technical analysis. He was always down in the soybean pit. And traders, the way traders make money in the pit, especially locals that they trade, their mentality and the way they trade and how they make money is very, very different than making direction-based decisions off a screen. But anyway, so in fact, it's so different that you almost really couldn't classify the two as being trading. The guys in the pit would say they're traders. The guys on the screen would say they're traders. There's such a vast difference between the two that one of them can't be trading. But anyway, you'd have to call it something else. You'd have to just call it something else. But anyway, so he sat down with the analyst and to learn about this mysterious technical analysis, and that's exactly what he looked at. It was somewhat mysterious, and the analyst would always talk in real definite terms, very arrogantly, like, okay, this is going to be the high of the day, this is going to be the low of the day. So in one particular day, the market was trading in between what he said was going to be the high, going to be the low, started drifting down to the low. And so the chairman said, hey, so this is going to be the low of the day, right? He said, yep, that's right. This is the low of the day. So he picked up the phone right next to him with a direct line to the soybean pit and said, sell 2 million bushels at the market. And the soybeans dropped 10 cents in a matter of, like 5 seconds. And the guy's looking like, what the hell happened? Okay, random results. That was the pattern that he was looking at told him that was supposed to be the low of the day. All it takes is one trader somewhere in the world to negate the positive outcome of your edge. Okay? But the reality of trading or thinking in probabilities has to do with 5 fundamental truths about the nature of the market and trading. In this section, we're going to discuss how prices move and who the players are behind it. When you understand how traders make prices move, then how you need to think to generate consistent results will start to become clear to you. Okay, where we're going now is that I think what I said when we
What's up, guys? Finished backtesting session this morning. Gonna take a quick look at some charts. And like usual, if there are any periods that you guys want to go over, just type them out live chat. We can actually stay on here for NFP. But if I'm gonna just change the title real quick. NFP watch. Well, anyway, it's coming out in 30 minutes. So, yeah, I'll stay on here for NFP. I'm looking for prime setup for this week is GU to scale down. And let me close out MT4 so my computer can stop crying. Fix that out. Cool. And I'll share my screen in a second. But if you been following the 25 charts and also basically just the Discord server, the link to that's in the description. Been sending up updates on GU for a sell is what I'm looking at there. I was looking for a buy on Euro USD. I took the initial entry, but that got stopped at a break even, and then the next setup never became valid. So I'm not looking for a position on EU anymore, just focusing on GU and EJ at the moment. So let me show you guys. Main view. Yeah, let's do it. Okay, so this is GU. Holding this position since, I think I've been holding it for at least 2 days now, since the 4th, right? And looking for the push. Now, price could get a little bit crazy. Like, we get a spike up, then a spike down. Just really extended wicks. So possibly putting another entry and putting SL would up there would be smart. I'm not going to move anything for this position. If I have to, I won't be able to re-enter. For if news is coming out, I like to enter an hour to 2 hours before, because generally during that time, price will give you a signal telling you, okay, when news comes, I'm going to push this way a little bit. When price comes out, that's pretty much the direction it's coming. At least, now that's not an actual rule. That's just something that I notice sometimes, or that I've noticed enough to say that. Euro USD setup failed. Euro JPY holding 2 positions and just looking for the sales here. Now, one thing I forgot to do on yesterday's call is actually look at gold and US 30. And review, see like where those are at, because we had analysis on those, which gold played out to the first TP. US 30 there was no setup, at least recently, because like there was no structure for me to base a setup off of. But I am looking for it to scale down. Let's go to gold first. Gold, hey, look at that. All right, so from this point, this was our TP1 on off of a previous setup. Was looking for price to scale down to this buying area and was looking for a buying opportunity from this point. At the moment, now that price has gotten down there, it's gotten down there differently than what I originally wanted to see. So at the moment, I don't like this too much. I'd rather wait for an impulsive push up and then look for a correction to buy off of before doing anything. So what that means is wait for this for a buy and obviously wait for the inverse for a sell. Just looking for it to range again back to the top, at least right now. Now, if price does break below this zone, then look for a sell setup, and that will take a while to set up. It's not something that I'm looking for like right now. All right. Yeah, so right now at this moment, there's no setup for me on gold personally. Just waiting for that possible buy. But with news coming out, it's probably going to be an aggressive push in either direction, like really aggressive push that you wouldn't even get that position, at least for my setup. Let's go to US 30. Again, if there are any pairs that you guys want me to go over before we end this call, type it out, or if you have any questions, go ahead, type it all in the live chat as well. Okay, US 30. We have not gotten a setup for US 30 since what? August 2nd, since last week. And that didn't even properly set up. So half price ranging here. Price has been like tweaking outside of the range, so I'm gonna go ahead and extend this a little bit. Scaling up higher. Would like to see it scale up to this point. Price is creating lower lows. Hasn't really broken this high yet, and not really looking for it to break the high, at least at the moment. So what would be interesting to see, I would love for this to actually be a break of the trend line, small correction, continuation to downside on the 15-minute time frame. That's what I would love to see. That's like the perfect scenario for me. I wouldn't sell right at this zone. It's a high risk setup to sell in this situation because we don't know if price is going to respect this level or not. But there are levels down here that haven't been tested, so I would like to see price continue down or like push down for a short period of time. So that's what I'm looking for today on Friday. So went over GU, went over EJ, and we went over Golden US 30. And that's really, oh no, there's one more. AUD USD, which is phenomenal. The longer this week has gone on, the more and more I love this setup. This setup is beautiful. This setup is like textbook. It's literally perfect. So, and it's offering about a 9-to-1 opportunity for me. So that's really, really good. If you don't know 9-to-1s are, or 9R is, it just means if I risk 1%, have the possibility to get 9%. My target's at 9%. And if you don't know, 9% within a month is really good. It's honestly phenomenal. So that's why it's a really, really good least risk reward situation. The reason it's a really, really good setup, I need to stop saying that. The reason it's a phenomenal setup, we have an impulse here, nice correction, which has perfect structure with a bearish flag, right at the 61.8 and at a selling pressure level. It's given us several signals to actually enter here. Now, earlier this week, I wasn't planning on entering this trade because I already had too many positions open. But being stopped out at break even on EU, and then UJ also got stopped out on at break even at a position up here, and then another position right here. Price came back up to where my stops were, got stopped out in profit on one, and then stopped out at break even at the other. Now I'm free. Now I'm open to take a trade. So this is what I would be open to taking. Now, obviously, the risk gets involved because it's Friday and got to hold over the weekend in order for that target to actually be hit, unless something really aggressive happens today. But we'll see. We'll see what happens. Just that right there. That is okay. So looks like there are no requested pairs. We have about 15 minutes until NFP comes out, right? So I'll stay on just 5 minutes after. I'm not one to really trade news, and I mean, we just have 15 minutes, so why not stay on here and check it out? If you guys do have anything you want to talk about, go ahead, type it below. I'm gonna go ahead and play Mark Douglas recording or seminar again as we're waiting for this to happen, and we're gonna actually watch GU. All right. Also, if you guys do like the stream, please go ahead, hit the like button. Also subscribe if you want to keep up with future content. I don't do the NFP all the time. I may make it something regular. No, I mean, why did I say that? No, I'm not gonna do that because I don't trade news. It's just perfect timing at the moment. All right, I'm gonna go ahead and mute myself.
Just before the break, is that when you guys understand the nature of price movement and how any technical methodology that's based on a mathematical formula or a price pattern interacts with that movement, when you understand that relationship, how you need to think will become self-evident. Do you remember me saying that? Okay, this is the part that we're going into right now, okay? In other words, where you understand just exactly how prices move. Because what I found in doing these workshops over the years is that here I'm addressing a group of people who trade and who in many cases have traded for years. And if you ask somebody exactly how do prices get from one price to the next, they can't tell you. They don't know. They don't know how it happens. And maybe you guys are, I'm sure you guys aren't that group, but we'll go over it just as a refresher, okay? We'll do it as a kind of refresher. So, oh. No, actually, I haven't addressed a group yet that there were very few people, or if anybody, could tell you exactly how prices move from one price level to the next. So, for an example, 10, 9, 7, 6, 11. Okay. If the last reported price that you see on your screen of something is 10, how does it get to 11?
They asked 12.
What?
They asked 12.
Who's they?
Market maker.
The market maker asked 12, okay? Well, no. Well, okay, it's at 10. How does it get to 11? How does the price actually move to 11? Well, more buyers, but that's true. But then again, when you what's that? Demand, okay. But when you look at 10, what you have is you have offers at 11 and you have bids at 9, right? Everybody understands that? Okay, now, there's only 2 ways that anybody can make money in this business. There's only 2 possible ways, no matter what strategies you're employing, no matter how elaborate they are, no matter how simple they are. You have to be able to buy something at a low price and sell it back at a higher price, or sell something at a high price and buy it back at a lower price. Are we in agreement on that? And would you also agree that everyone that trades is trading to make money? In other words, I'm going to say that there isn't anybody who puts on a trade that does so knowingly and consciously thinking it's going to be a loser. In other words, where they go into the market and say, my purpose is to lose money. Okay, you guys with me on this? Now, if the only way that you can make money is to buy low and sell high, or sell high and buy low, and the last price, posted price, is 10, which represents the value at that moment, then what's low? 9 is low, and what's high? 11. What's the only way that it can get to 11? Somebody thinks 11 is a good price, meaning that they have to buy high relative to the last price, right? So for an example, so base also means is that all the offers have to be taken out at 10, do they not? Anybody who had an offer in at 10 that wanted to sell at 10 will get filled, and all those offers have to be taken out for the price to go to 11, correct? And of course, and for the price to go to 12, all the offers that existed at 11 have to be taken out so that someone could actually bid the price up to 12. For prices to move, somebody literally has to bid the market up. Or for prices to go lower, it means that someone has to offer it lower. Now, if the only way that anyone can make money is to buy low and sell high and buy low, why in the world would anybody bid the market past the last posted price?
Because he thinks he got a winner.
Conviction, exactly. Conviction. In other words, what you have is a situation where on every trade that exists, there are 2 people on both sides of the trade. Even in stocks, there's even someone who's selling a stock, not like a commodity where in a futures contract or an options contract, there's 2 people on both sides of the trade. There's a buyer and there's a seller, and the next tick is going to make one of them a winner and one of them a loser, right off the bat. If you and I enter into a trade at 10, okay? We enter into a trade at 10. It means that you, in essence, if you're the seller, let's say you sold them at 10 and I bought them at 10. The next tick is going to make one of us a winner and one of us a loser. If the next tick is 9, the amount of money that flows into your account is coming directly out of mine. Are you guys with me on this? If the next tick is 11, the amount of money flowing into my account is coming directly out of your account. Okay? So basically what you have is you have two diametrically opposing beliefs entering into every single trade. Every trade that is made, there are diametrically opposing beliefs about what the future is going to be. So again, I'm going to say, what would cause anybody to buy high or sell low? Just conviction. In other words, what you have is a situation where if someone's willing to bid a market up to the next highest price, basically what that person is doing is that person is stepping out, saying that my conviction that the price is going to go to 12 or beyond is so great that I am willing to do the opposite of what I need to do to make money. Think about what I just said. I am willing to do the opposite of what I need to do to make money because my conviction is so strong that the next price will be 12 or 13. Otherwise, this person would wait. If this person thought the next price was going to be 9, then they'd buy lower. If they thought it was going to be 8, they'd buy low. They'd wait and buy lower. Whereas, so what happens is that the person who's willing to bid a market up and take out these offers at 10, take out all the offers at 10 and bid it up to 11, has to have a stronger conviction in the future than the person who sold it to him at 11. Because this person is creating price movement, is actually creating movement, and the person on the other side of the trade is being passive because they're doing exactly what they think they need to do, and that's sell high relative to the last price. Are you guys with me on this? Okay, everybody understand it? Now, I want to ask you, is there anybody in this room who has purposefully bid up a market? There are some people who've actually bid a market up. In other words, the people who've actually taken the offers, all the offers out at the next highest price and bid it up. Do people like that exist? Yes. So in other words, we are aware of the fact that there are traders who both have the financial and the psychological resources to actually purposefully bid markets up or offer them lower. We're together on this, right? Okay. So basically what you have is that all price movement has to be a result of an imbalance in the degree of conviction between the traders who believe that prices are going up and those who believe that it's going down. That is the only way that prices move. It doesn't matter what the reasons are that people tell you about why they did what they did. Or it doesn't matter what the reasons that you hear on CNBC or whatever about where the market is and why it went the way that it went. Ultimately, it all boils down to an imbalance in conviction. That's the only way prices can move. Because the only way they can move is for someone to actually purposefully bid it up or offer it lower. And for them to do it, there has to be, like a sense of strength in terms of energy in their belief that the next tick is going to make them a winner. Okay, so we basically, does everybody understand? Everyone's with me on this. All price movement is a result of an imbalance in conviction between the buyers and the sellers. Every trade that's made, there's somebody on both sides of the trade that have diametrically opposing beliefs. You're always having, with every single trade, there's always a clash. There's always a clash in wills and a clash in belief in terms of what the next tick is going to be or what the future holds. We've got two people entering into, in a sense, an agreement by making a trade, but both of those people have diametrically opposing expectations of the future. And one of them is willing to say, hey, you know what? My expectation is so great, is so strong, that I am actually willing to do the opposite of what I need to do to make money and bid a market up. Now, there are traders who will do that. I call them dynamic traders. They are the people that have, like I said, both the financial and the psychological resources to actually bid markets up. What the typical, and what I'm going to call everyone else, passive technical traders, okay, they've got dynamic traders and passive technical traders. What the typical
Okay, Mark. This reminded me of something. Like sitting here waiting, I was like, this. I used to do this when I first started trading. and it's not, unless you actually trade news and pay attention to it. It's kind of like gambling, because like you're sitting there in anticipation, waiting for it. You're just staring there, counting down the minutes for this news events to come out, and you're looking for your push. But I mean, of course, like timing plays a factor into it, and like understanding when major news is coming out is going to be significant to how you trade. But it shouldn't be something that riles you up emotionally, and the outcome of it basically allows you to be in a good mood or a bad mood. It shouldn't decide your mood. And I really just wanna leave right now, honestly. But I said I was gonna stay on here till it comes out, so I will. We have 3 more minutes. Matter of fact, I can just do this. Oh no, don't do that. Don't do that either. Man, that sucks. Mm-mm-mm. That part's about to be taken out. I did it again. Oh no, we're good. That's awesome. I thought I would scroll down or on a different section. Alright, so that part can stay in. Awesome. Okay, accomplished the goal being on here till 8:30. So I'm gonna go ahead and hop off now. I hope you guys enjoyed the stream. I enjoyed it. Gonna go ahead and timestamp the video, and then I will catch you guys in the next one.